In June 2019, the United States officially logged the longest continuous economic expansion in its history. On paper, the engine of American capitalism was roaring. But beneath the surface-level metrics of GDP and aggregate growth, that same engine was systematically fracturing the financial stability of the middle class. Leadership across the political spectrum, including Federal Reserve Chairman Jerome Powell, repeatedly cited this era as a period of unprecedented inclusion and shared prosperity. The data from the household level tells a different story. Real median wealth for the middle class remained stagnant, while a vast swath of the population functionally lost economic ground. By the end of this supposedly historic boom, 37% of American adults, nearly 100 million people, reported they could not cover an unexpected expense of just $400. This fragility reveals a blind spot in the macro metrics used to declare victory. The headline numbers were rising, but they completely ignored the distributional reality on the ground. Historically, U.S. inequality tracked Western Europe. In 2010, the lines violently decouple as the U.S. top 1% shoots upward. Meanwhile, bottom 50% wealth collapsed and flatlined, while the top decile grew 19%, creating a massive visual chasm. This divergence occurred independently of organic market fluctuations or long-term shifts in the tax code. To understand this divide, we have to look at the specific monetary and regulatory policies enacted in the wake of the crisis. The evidence suggests that by 2010, the central bank had effectively taken over the inequality engine, becoming the primary driver of modern wealth concentration. Quantitative easing, or QE, was the first major policy lever pulled by the Federal Reserve after the 2008 crash. Through QE, the Fed bought trillions in safe assets from banks, injecting massive liquidity. Starved of yield, capital was forced into riskier assets, flooding the stock market and drastically swelling equity prices, regardless of the economy's health. Asset inflation maps directly to the top of the wealth distribution. Today, 86.5% of all equities are owned by the top 10% of households. This cheap liquidity allowed corporations to enrich existing shareholders through stock buybacks and dividends, rather than issuing the job-producing loans or capital expenditures predicted by the Fed's models. The mechanical result of QE was a structural wealth transfer to the top tier, leaving its intended goal of broad economic stimulus largely unfulfilled. The second primary lever was zero interest rate policy, or ZIRP. This pushed real interest rates to zero, or even into negative territory. Negative real interest rates invert the historical relationship between debtors and creditors, turning conservative saving into a losing proposition. Consider the historical math. $40,000 saved over 20 years at a 5% rate, adjusted for inflation, yields $49,000. Under ZIRP, that same principle at 0.5% yields only $30,000. The policy destroyed 25% of the saver's purchasing power. While middle-class savers were penalized, the top 1% utilized these ultra-low rates to access cheap leverage, amplifying their market speculations through carry trades. This neutralized the primary tool the middle class historically relied upon to build multi-generational wealth, the bank savings account. ZIRP functioned as a regressive tax, penalizing conservative financial behavior while heavily subsidizing elite speculation. Beyond monetary policy, the regulatory response to the 2008 crash introduced a third mechanism of inequality: strict new capital requirements. These rules successfully fortified bank balance sheets against another collapse, but they fundamentally altered the banking business model. Tougher capital requirements made lending to low to moderate income consumers highly unprofitable for traditional banks. In response, the regulated banking sector pivoted away from the middle class, focusing instead on corporate lending and high-end wealth management. Starved of traditional credit, consumers are increasingly pushed into the ecosystem of unregulated data-extracting tech monopolies for basic financial survival. By prioritizing systemic safety over equitable credit access, the regulatory state inadvertently starved the middle class of upward economic mobility. These destructive distributional outcomes have been evident for a decade, yet the Federal Reserve maintained its course. This persistence is driven by a theoretical framework known as the wealth effect. The wealth effect is the assumption that inflating elite asset prices will eventually create a trickle-down economic boost for the broader population. the Fed relies on a dashboard of aggregate metrics. From this perspective, the recovery looks healthy: GDP climbing, headline unemployment dropping. However, looking at distributional data breaks this illusion. While aggregate numbers rose, the Gini coefficient accelerated, and bottom 50, the massive safety net beneath financial markets must be retracted to curb moral hazard and halt extreme asset inflation. The third fix is symmetric regulation. Applying like-kind rules to all financial actors ensures that consumer lending isn't entirely abandoned to shadow tech platforms. Ultimately, money is the fuel of the inequality engine, and financial policy dictates precisely where that fuel flows. Until the central bank calibrates its economic models to distribution reality rather than aggregate averages, the underlying architecture of the U.S. economy will continue to structurally enforce inequality.